Good morning. It's Sunday, January 9, 6:30 a.m. Welcome to episode 29. Stay foolish, stay invested. Happy New Year to you, Wowie.
Happy New Year, Mark. How are you?
Good, sir, and Happy New Year to our listeners. Thank you for sticking with us so far. I hope everyone is off to a great start this year. This is your host, Mark Yu,
And Wawi Santos.
and welcome to the Mark Yu and Wowie Show. Disclosure: this show is made for sharing information purposes only, and not to be considered investment advice. We record once a week, or try to at least. And while we are both physical therapists here in the USA, with the same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you guys for your hard work. So our last episode before the end of the year, or just last week, we were selecting our top picks for 2021. If you guys have missed that, you can feel free to go back. And for those who have been sticking with us since day one, thank you guys for sticking around. Don't be um, you're in for a surprise in our upcoming episodes, as we are having some guests to join us. So for this week, we're gonna proceed with the Apple becoming the first $3 trillion US company. So first time ever in our history, Apple has reached the 3 trillion mark, but it didn't stay up there for a while. I think it just lasted for a few twitches, and it
Mhm.
pulled back a little bit. At this point in time, Apple is still hovering around $2.8 trillion in market valuation. So I did this simple comparison. Well, it's not apples to apples, but it's kind of like apples to oranges comparison. I compared it to our homeland's GDP, the Philippines, gross domestic product. So, in comparison, Philippines generated as a country net expenses and all that generated around $300 billion. So it's quite a big difference if you're gonna divide it and you're gonna look at it that way. It's like 10 times. Well, is it 10 times? Let's see. 3 trillion. Yeah, nearly 10 times bigger the size. Imagine Apple is like, in terms of monetary valuation, it's like more than 10 times as large as the Philippines, the Philippine Islands. Mhm.
Sounds like you want Apple to acquire the Philippines rather than China.
Yeah. Speaking of, I think China, I think is still at least the second largest economy in the world, right, Wowie?
It is, and it's projected to outpace the United States in a
Hmm.
few years.
Right. Yeah, it's becoming bigger and bigger. The dragon of the southeast or east Asia. I don't know, but yeah. Second one is on the largest companies in the world is Microsoft at $2.36 trillion, and the third one is quite interesting. It's not based in the USA, as one might have assumed. It's based in Saudi Arabia. It's Saudi Aramco.
Oh,
It's one
yeah. Ooh.
1.89 trillion valuation.
Wasn't
And
that supposed to go IPO? Um,
yes,
are there any talks lately?
haven't heard. There hasn't been any update, but yet, yes, you're correct. I just remembered. Thank you for reminding me. Yeah, they were trying to actually list at least 10%, not even the whole company, of course. They're trying to list
Mhm.
a partial stake of their company for U.S. investors to invest in, but I don't know what happened there. But next one is Google at 1.8 trillion. A quick rundown of the largest companies in the world, followed by Amazon 1.6 trillion, Tesla 1 trillion at $1,000 a share, $1,000 and 27 a share. Meta or Facebook 922. I think at one point Meta was $1 trillion, right? They
I
have
think
breached that.
so, yeah. Hmm.
And then Berkshire Hathaway at 700. There's quite a big difference from Meta. So seventh place is Meta at 922, and then Berkshire at 711, about $200 billion difference. But you have a take on this, Wowie. What would you say about Berkshire?
Well, I just read an article um, on the internet that Berkshire may be
Mm-hmm.
the next $1 trillion company. It's because of the, it's everything is shifting back to value.
Uh-huh.
Well, there's a trend towards value now because of rising inflation, and Berkshire has been buying back a lot of its shares, so it
Right.
has a lot of cash,
Mm-hmm.
dry powder on hand, um, for more acquisition and for more growth. So if you
Right.
look at Berkshire, it really is a growth company now. Now that
Mm-hmm.
things are shifting back into the value sector.
I think the I just speaking of Berkshire, I just saw an article sometime last week that their largest investment, Apple, was their like best investment ever because they just put in around $30 billion, but it had produced a return of more than 100 billion. And
Wow.
and Berkshire is not like holding it like all of it that they have bought. They have been selling quite a bit as well, realizing some around less than $10 billion. But still, their ownership has even increased over time because of Apple buying back its shares. And that's the
Mhm.
beauty of what Buffett always looks at in a company when he buys in, like a company that's providing good dividends or stable free cash flow or buying back its stock. For the listeners that are not unfamiliar, so Apple engages in a specific activity called share buybacks, where it uses its extra cash to buy more of its shares. As a result, the current investment holders or stockholders of its company, as a result, there are fewer shares, so the current holders in return own a little bit more of that company as a result, because they're supply and demand, a lot less shares, more ownership for the current shareholders. So number 9 is Nvidia at $679 billion, and number 10, this one is not based in USA, but based from Taiwan. It's Taiwan Semiconductors. And
Mhm.
looking at the 30 price, so I don't usually I mean, for me, I don't usually look at charts, but if you're going to look at the charts of these companies on this website, companiesmarketcap.com, I just discovered this website this morning, which is quite interesting. So price for 30 days for all tech companies except for Apple, each one of them are flying, or not flying, but going down on the red for the last 30 days. And like what we said, Berkshire for last 30 days has been just climbing up.
Mhm.
So quite an interesting take right there, as value definitely is back in play. We're gonna look at some fund flows in a little bit, which would definitely give more meaning um, to what we have just discussed in terms of value versus growth. So this is an article just published yesterday or Friday, January 7th. This is the monthly jobs report that the government does every first Friday of the month. So U.S. jobs report came out Friday. It disappointed because payrolls rose just shy of 200,000, less than half of projections. So I would say Wall Street was expecting more, 400,000, but still, unemployment rate, which the Fed or the Federal Reserve is closely looking at, dipped below 4%. So, a toss up there. But as we have pointed out, I think Thursday or Wednesday, when the FOMC or Federal Open Committee came out with their minutes, which kind of like summarizes their meeting, um, they indicated that they would be hiking rates faster or sooner. So this quite sent sent some shock to the stock market, primarily the tech industry, which suffered big losses compared to the industrials or the value stocks. So on this jobs report, Reuters came out this excellent summary. They just published this right after the FOMC minutes, or not the FOMC, the jobs report number. So they came out with 5 notable numbers from the report. So they just said number one, people are making more money. So uh, making more money in terms of like average weekly pay was up nearly 6% in December of 2021 compared to December 2020. So that's of course not considering the inflation that kind of like takes a big chunk or higher, according to Bill Ackman, like me and Wally have discussed a couple episodes ago. If you're gonna compute for the real inflation, it will be hovering around 10%. So 6% rise of pay, weekly pay, compared to 10% rise in inflation doesn't add up too much. Next, that Reuters came out with number two, unemployment hits a pandemic low. As we just said, it dipped less than 4%. This is the lowest where we have been for past 2 years. So we've been struck by COVID for 2 years now, and this is the lowest unemployment rate. So this is what the Federal Reserve have been closely looking at. So probably because this is the reason why we are kind of feeling some shocks, as people are expecting the Fed will probably be more aggressive now. So we're now down at 3.9 from 4.2% in November. So
Well, most analysts and talking heads, except for some um, proponents of um, a crash
mm,
in the market, a lot of the analysts and um, are saying that the economy really is geared towards a growth of about 4 to 5% here in the U.S.
mm,
So it's not gonna be a hot market. It's gonna be more of a slow growing market for projected for the year, based on initial jobs data and inflation and current socioeconomic situation here in the country.
so it's the GDP or the stock market that they're looking at 4.5
GDP,
GDP, right?
yeah, close to 5%.
5%, right? Still a good number. I'm not. In my opinion, I think, right? A little
Yeah,
slow coming off of COVID for sure, but oh yeah, yeah.
yeah,
That reminds me
and
of the
it's
facts that research. Mhm.
mhm.
Mm, they
and
they
that
said, yeah. Go
I'm
ahead.
s-
Sorry.
yeah, and that projection is equivalent to the global projection for the GDP, which is
So
4.9.
it's kind of like at least within the range in terms of global, at least
Yes.
worldwide growth. We're still USA is still within that kind of like
Hmm.
range. So yeah, that reminds me of FactSet research. So for our listeners who would like to who wouldn't like to go back to our previous episodes back in December, I think FactSet research came out with earnings per share growth of a slowdown, low back to the low like mid single digits compared to the double digits that we've seen in 2020 or 2021. So that kind of reflects, you know, the profit margins kind of being um, reduced a little bit with people not spending more. So yeah, going back to the jobs report. So unemployment, this is the number three, I think Reuters came up with. So by ethnicity, black workers saw their unemployment rise in December, 7.1%. So not everyone in terms of like ethnicity has benefited so far. Next thing that Reuters pointed out in the jobs report, December hiring was less broad based. So this is what kind of caught my attention. So the labor market seems to be it's in a stronghold right now. Is in a good footing with an employment rate dipping below 4%. But according to the Labor Department's diffusion index, as Reuters have pointed out, the diffusion, a gauge of how well distributed hiring activity is across 257 private sector industries, it indicated that while hard hit industries like leisure and hospitality continued their recovery, hiring activity stalled or dipped in such industries as retail, financial services, healthcare, and government. So there are branches among the 257 industries that indicated a decline or even stalled or decline in those industries. Financial services and healthcare brings into interest because if this is the value that we're looking at, right, Wowie? This is the value industries. So it's
Mm-hmm.
either they're experiencing some a little bit of a pause during the Christmas break. This is the month of December,
Mm-hmm.
or this is something to we need to keep an eye on moving forward. And the last one is the U.S. hospital employment. So despite the Omicron surge, this is in December. The Omicron surge, as we're going to look at the chart on the following slides, has rapidly increased this month in January. So December, it kind of flattened in terms of employment in the hospital. So we're looking at a possible overcapacity in some of the hospital and further strain on our healthcare workers. So it's not an easy task. So we're hearing all about these school teachers complaining, not wanting to go back to work because of the virus, but we're not so much hearing about healthcare
Mm-hmm.
workers being swamped by new admissions. So,
Well, what I know regarding healthcare is the dearth of nurses because of high hospitalization rates at this
right.
time. So what's happening is a move towards higher pay.
Mm-hmm.
So a lot of the nurses that are employed are moving into travel positions.
Right.
So they would have more flexibility and an increase in opportunities of higher pay.
Mm-hmm.
They're moving a lot of nurses right now in these areas of shortages. I
Right.
read something like 10,000 nurses are going in the hard hit areas where
Mm-hmm.
there's a shortage.
Yeah. I saw a news article on Thursday, I think, that Dallas itself finally they're on the newspaper finally got um at least 1,000 nurses deployed as travel to support their hospital systems over there because they're getting flooded or swamped with the
Mhm.
you know with the viruses, hospital admissions. So we're gonna see in the chart a little bit how bad it is, but I think hospitalization rates have increased, but the ICU at least has you know in par compared to where we were at before, has at least been a little stable. So
Mhm.
fund flows. So this is an interesting graph or interesting information we pulled up this morning. It's from U.S. News. Fund flows. U.S. equity funds receive inflows in the week, this first week, despite the sell-off in the hot once very hot sector, tech sector. So, according to Refinitiv Lipper data, investors purchased U.S. equities totaling 8.98 billion, down from the previous week's inflow of 18.55 billion. So it's quite a big dip in terms of fund flows purchasing US stocks. But still there are fund flows going in. But quite a dip. So it says here among sector funds, financials, real estate, and healthcare are the ones that attracted the most fund flows. Tech, here we go. In contrast, tech funds witness outflows of zero point 0.6 billion. So it's not that much sell off, but definitely quite a loss. Not so much flowing into the tech. And as you have pointed out earlier, Wawi, US value
Mhm.
funds, value sectors, which consists of energy, financials, there lower price to book values. For listeners who are not familiar, these are lower, like less pricey stocks compared to the high flying tech stocks. Lured or garnered 1.21 billion dollars and posted a third straight week of inflows. So third straight week of inflows to value sector, while
Mhm.
growth has faced outflows of 712 million after two successive weeks of net buying. So it was only this week that we've seen some outflows out of the tech sector. So if you're gonna look at the graph for the YouTube listeners or viewers, you'll be able to see here the fund flows. So all along for past month, we've been seeing some inflows to growth funds since December 22, 29. But we've seen some outflow on week of January 5th. But if you're going to look at further back, actually in December, even during the Christmas rally, there has been quite a outflow, like nearly $15 billion of outflow at 1 week that ended in December 15. So this is
Yeah,
quite interesting.
usually that's a rebalancing. A lot of
Uh-huh.
investors are rebalancing their portfolio at that time.
Probably so. Yeah, I agree with you.
What we're
Makes sense.
seeing probably, Mark, and correct me if I'm wrong,
Mm-hmm.
this is probably a more of an automatic um, trading, like
Right.
algorithmic trading.
Like algo. Uh-huh.
Yeah, what's going on this this uh, um, this time of the year based on the news? I think they're processing the information from recent uh, Fed decision and inflation data and jobs related data,
Right.
and that's causing that outflow from some of the growth stocks.
Yeah.
um, we will see more by December. I think a lot of this inflationary play is still taking place in the
Mm-hmm.
supply demand area. i'm I'm speculating, and I hate to use that word, but I'm speculating that there would be this supply demand play until June of this year,
Right.
um, because we still have a high inventory. We just can't move it fast enough, um, and I think the big companies are benefiting from this. They have more pricing power and leverage right now
Yeah.
to increase their prices. And I think they have until June to do that until
Mm-hmm.
people start noticing, oh, okay, what's going on here?
Yeah. I think
There's a lot of supply, but how come
yes.
prices are still high?
Yes. Once congestions ease for sure, with supply law of supply and demand in economics for sure, people would start noticing that there have been more stock. And but yeah, anecdotally, me and my girlfriend were just in the outlet store yesterday, and there's not so much stock in there. Like I'm looking at the Lacoste, in particular Lacoste store. So they have the women's section and the men's section. Men's section, they only have like two racks, two stalls of clothes
Mhm.
with at least five long sleeves hanging. And then right after that, there's gonna be like shoe boxes all the way to the end. And so if you're gonna look at your size, maybe it's because an outlet store they put less priority in it. But it's definitely quite a change from where it was back during the lockdown days. When they still have lots of lockdowns happening and not people shopping, not enough people shopping. There are lots of clothes laying around and lots of discounts and all of that. So right now there are a lot less options for sure. So inventory is still a little bit tight, but once this easing in ports and deliveries and congestion have eased down, I think yeah we're gonna face some price corrections in terms of
What
inflation
what
wise.
what I see benefiting from this probable normalization of supply would be companies that are in the REIT sector,
Mm-hmm. Real
that
estate.
that's
Yep.
that's in the warehousing
Uh-huh.
sector. And in particular, we should probably put Stag on our watch list to see how that goes.
So Stag is what's Stag?
Stag is like one of the largest industry warehouses here in the United States.
Mm-hmm.
And I have to say, this is not just a particular trend here in the United States. You could also see this type of trend in Asia. And my sector of focus will be in the Philippines. There's an increase in warehousing opportunities in the Philippines as well.
Right.
for moving products.
Yeah, and I think back a couple years ago, even before COVID, Huawei SM had purchased To Go, one of the couriers there in the Philippines.
Yeah,
So
with the increase in Shopee or online retail,
mhm,
warehousing would be much needed because stores um, are not right now not popular destination for most people because of the virus fears. So you're gonna see more of these products being stored in warehouses and then
warehouses, right?
being moved by trucks.
Yeah, and I think the Philippines also has gotten better with their delivery system due to this, changing times.
A
Like,
lot of opportunities there as far
mhm,
as the
it's,
Asia Pacific region, infrastructure opportunities.
yeah, quick deliveries. You can order a donut and have it delivered within, the same day, few hours. It's like at least in terms of technological adaptability, Philippines is getting there. So I don't know if I'm gonna be shorting SM, but
Oh,
still, it's gonna be a quite an interesting movement in terms of technology adaptability moving forward. Yeah, but yeah, going back here in the fund flows, as you would see, healthcare, the dark blue, communication. So financials, like what the news said, financials received more flows, real estate and healthcare so far. So we're gonna proceed on to the next slide. So the tech sector has been, hit. Actually, Nasdaq is at its worst performance for the week since last uh, February 2020.
hmm
So it's not an impressive start so far this year for Nasdaq, but let's see. Yeah, Nasdaq has worst week since February of last year, 2021. Sorry, I misconfused 2020 with 2021. So, on this article by CNBC published just this Friday, cloud stocks are off to a brutal start to 2022 as investors sour on pandemic's top performers. So, on this article, I pointed out this interesting index, the Bessemer Venture Partners Index, aka BVP, Nasdaq Emerging Cloud Index. So in this index, it just shows like what the index is all about, what it's holding. So we're gonna get into that shortly. So we're just gonna look at its performance first. For the week, it's down 11 or almost 12% compared to Nasdaq's 4.2%. Um, for the past since it was founded though, it's still up almost 1,000%. So its portfolio consists of, in terms of market capitalization, or the biggest of which, it has Adobe, PayPal, Salesforce, Shopify, ServiceNow, Snowflake, Atlassian, Square, Workday, Zoom, Datadog, CrowdStrike, and so on. So definitely, it's more of that tech, high flying companies. So we're gonna look at some of the some of these companies. For our listeners, you're in for another treat. So we rarely do these and take a deep dive on this company. So we're gonna get started. So first one is the one of the largest companies, if not the largest company in Canada. It's Shopify. So we go ahead right now and dive into its numbers. Its revenue looks like it nearly added $1 billion or $1.3 billion more so far in terms of its revenue. So its sales. So usually, what I would like to focus on these financials is its sales or revenue and profit. And we're gonna look also into its balance sheet just to be sure that they're able to supply, or be steady afloat if in case interest rates hike up too much, and payments would still be manageable. So sales have increased, which is a good sign, we're just gonna look at the 2020 compared to 2019 since we just started this year, 2021. And profit for 2020, it has risen to $320 million compared to last year's or 2019's 124. So that's nearly a 400 million jump, which is impressive for a company in Canada. So I think Shopify hosts websites for sellers compared to Amazon, which holds all of its products or has their own fulfillment centers, right, Maui?
Yeah, I think Shopify allows store owners to move into the online retail sector.
Mhm.
It helps them make the movement more plug and play,
Right.
which makes them very attractive to those that are trying to sell their products online. It's kind
Right.
of like Shopee, right? In the
Mhm.
Philippines, it's Shopee. Here, it's Shopify.
So the seller, like for example, would like to sell clothes. They're just gonna use Shopify services to try to reach that customer on the online space, right?
Yeah.
And
Yes.
Shopify can help them with the ads and establishing their website, fulfilling their
e-
orders, and all that, right?
Exactly. It sets up their store, which makes it very convenient for those that are trying to get into that business.
And I think there's a battle between Shopify and Amazon because Amazon kind of like labels everything or would require their sellers to meet certain criteria to be in their Prime services. Amazon still has the
Mhm.
important Prime aspect, the 2 day shipping and all that. So give or
Well,
take, I
just
think they're both
I just see Shopify like your mom and pop store
right,
competing against these big retailers, Amazon, Walmart.
right. And I don't think Shopify has their own kind of branding, like compared to Amazon. They have their Prime. They have their own kind of like self-stored label. Like they have their own kind of like I can't think of any right now, but they have their own products to sell directly to the customers in addition to the selection that the buyers could find from other sellers. So regardless, Shopify's balance sheet, we're gonna look at their cash. They're standing at $7.5 billion as of September, which is a good amount. And their total debt. So, by the way, we're using the Seeking Alpha website. So, usually Seeking Alpha has readily made available these numbers. Total debt 1.1 billion. Shopify is liquid. I mean, it can pay off this debt and still come up with $6 billion in cash. So
Mhm.
they're definitely liquid. We're gonna look into its valuation, price to earnings. We're gonna look at the forward price to earnings for next year's. They're trading around 44 times earnings compared to their compadres at 30 times. So they're still a little bit expensive, at least 50% more expensive than their median. But I mean, they're growing good. I mean, 400 million more in profits, a minute, a billion and a half more in sales. Terrific balance sheet situation, which is good. So,
Something to put on your watch list
oh yeah,
with this cyclical trend
yep,
to see if it's gonna turn into a good buy here in a few days.
right. Right now it's trading at $1,100 a share. So disclosure, I don't have any shares on this company. How about you, Mommy? Do you have it?
No, but it's been on my watch list for a while. I've been grabbing um, a lot of speculative growth
Hmm.
stocks lately.
Hmm.
Um, and But Shopify has been on my watch list for about 2 years now.
Right.
And looking back again, hindsight, I should have bought it two
Hmm.
years ago.
Right. Well, hindsight is 2020. So next we're gonna look at Salesforce. So another one of those high flying, or this is an old, not an old company, but relatively not not anymore young. They've been growing quite a bit, and they're a big company. So Salesforce now trading at $228 a share. Revenues. on 2021, hovering around $21.25 billion, nearly 18, 19, 20, $4 billion more from 2020. And their profit, wow, look at that, $4 billion in profit for 2021 compared to its previous year of 126 million. Wow, that's a big difference. 4 billion divided by 126. That's nearly 32 times more profitability for this company. So that's
What
quite a
does it?
big.
What is its main product?
I think it's cloud software,
Mm-hmm.
providing online solutions to not only small mom and pop investors, but business owners, but also to big companies.
I see.
I think they're in kind of like in competition with Oracle. Uh, I think Salesforce. I know I've heard more of their founder, Mark Benioff,
Mm-hmm.
and I think it's regularly before COVID. They usually have these annual meetings or presentations, and it garners a lot of attention because big leaders, big company leaders, uh, attend those seminars or presentations. So it's definitely quite growing business aspect, like the numbers show it for sure. Its balance sheet as a software or cloud business. Cash, they have nearly $9.5 billion in cash. And their debt, let's see, 14.3 billion in debt. So they have still, and despite their humongous cash in its balance sheet, they still have a bunch of debt lingering around. So not a quite a warning sign if you can grow your company that big year on a year-to-year basis. Definitely, you could still support your debt, but something to keep an eye on. Valuation-wise, Salesforce forward price to earnings. Oh my, 179 times earnings.
Oh, there you go.
It's compared to a sector median of 30%. I mean 30 times. So it's like 500 times more expensive. But I think disclosure, I have Salesforce in my portfolio.
Mm-hmm.
It's because of its cash flow primarily. Because I know they kind of generate a bunch of cash flow after their expenses. They retain a bunch of them. Free
Mm-hmm.
cash flow. Let's see. Yep, unlevered. Yeah, they generate 1 billion to 2.5 billion a year in free cash. So they're quite rich in terms of cash. But yeah, the lingering debt and the forward valuation. It's quite expensive at this point in time, despite the recent drop.
But more importantly, do you have any information regarding customer retention, acquisition?
No, at this point in
Mhm.
time, I haven't deep took a deep dive on its
So definitely
business.
something to put on the watch list again.
Mm-hmm. Yep.
CRM would be the ticker,
Yeah.
and I've been eyeing CRM as well, but I have not added it to my portfolio.
Right. I think back then I bought it during the lockdowns because it kind of like dipped. If well, we're gonna take a look at their stock price reaction in a little bit after dissecting their financials for sure. So next on the list, one of the largest on the index is Adobe. Let's see how big it is in this BV index. Adobe is 244 billion in market cap, $510 a share. So if we're gonna look at its sales in December 2021, sales $15.79 billion compared to $12.9 billion in 2020. So a growth there, 15.8 minus 12.9, nearly $3 billion in difference. And profits, let's look at its profits. $4.8 billion in profits compared to $5.3 billion in 2020. So $400 million difference, or 400 million less in terms of profits. If we're gonna look at its balance sheet, so it looks like Adobe has been growing its business. Back in 2018, it was only having revenue, not only, but 7 billion in revenue, but now it's hovering around $15 billion. So it's been steadily increasing over the last 5 years. Its cash in its balance sheet as of December, $5.8 billion in cash. And its total debt, it's 4.67 billion. So relatively fluid. This company is liquid. They can support their financing for sure.
This would be considered one of those stalwart companies at this time.
Yes.
Adobe has set its position in the large cap market.
Right.
I'm curious if it pays dividend.
Adobe, let's see. Adobe, well, I'm looking at the company's market cap. It's at the 39th largest company in the whole stock market, worldwide stock market. And if you're going to look at the 30-day price change, it's been definitely going down along with the other tech people. I mean, not tech people, but tech companies. In terms of dividends, let's see its dividends.
So if you're looking at stalwart companies, consider it more like a blue chip company.
Yeah.
You have to look into their dividend payout.
Looks like it doesn't pay any dividend.
I see.
It says here a dash or a nil compared to its industry. Its industry pays at 1%, 1.27%. Not that much. So we're gonna jump on the last one that we're gonna highlight on our company's review, which is PayPal. So PayPal has been suffering a lot of decline in recent times, trading at $187 a share. Its sales for December, they logged $21.45 billion, almost as much as, what was that company? Salesforce, right? Salesforce, let me see, it's
yes. Yeah, 21.25.
Wow.
With Salesforce.
Okay. All right. Okay. So it's kind of like Salesforce, but different, definitely a different business model here. PayPal is more of like, as we all know, it processes online payments to merchants and all that. Whenever you want to purchase something, PayPal button is there to use their services. They kind of acts as a security as well, as they make sure that your payment goes through, the seller receives it, and you can actually dispute any type of transaction that comes up during if the seller didn't deliver and all that. So revenues 21.5 billion compared to 17.7 billion. So that's quite a big difference. If you're gonna subtract that, you're gonna come up with at least $3.68 billion more in sales, which is quite a big jump, And net income for the company, they have registered for 2021 $4.2 billion compared to $2.5 billion in 2020.
It doubled. Well, we might as well call PayPal Venmo.
More than doubled.
Yeah.
Oh, more. Yeah. Sorry. Yeah, go ahead.
Yeah, it's more than doubled, right?
Yeah,
and
doubled.
I think that's what I said. We might as well call it Venmo because
Venmo.
One of its largest revenue, I think, comes from Venmo.
Right. Like Venmo now, it's like a Square, similar to Square's Cash App, right? Like you can send money through a friend using their phone number.
Yes.
All right. So next, I think we're trying to look at its balance sheet. PayPal. Where's PayPal among the ranking while we're waiting? Let's see. So Salesforce has a 52, believe it or not. So even generating more than Adobe. Salesforce, it's ranked at 52. Adobe is at 39, and PayPal is not far behind from Salesforce at 54 billion, right on top of Wells Fargo, which is quite interesting. PayPal is larger than the bank. So balance sheet, PayPal, total cash 13.29 billion, total debt 9.7 billion. Definitely liquid. This company is liquid. At $187 a share, let's see its valuation compared to its peers. So valuation of PayPal forward earnings is 52 times compared to its peers of 30 times, 76% more. So it's like almost similar to Adobe, whereas in terms of valuation, they're still a little pricey compared to its peers, but you're definitely paying a premium for a really good company. That's what I would say. And if we're going to look at their stock price, so going back to Shopify, since the start of the year, they lost nearly 20%. Shopify had dipped 20% in the past 5 days. The sell off in tech has definitely been painful for mostly tech investors out there. If you're going to look at the past year, since last year, they lost about 2 percentage points. So looks like they pretty much lost everything they have gained since 2021, since last year. If you're going to look at Salesforce, Salesforce has lost nearly 11% since the start of the year. If you're going to compare it to the 2021, so they're still up about 5%, 5% up for the 2021 performance. We're going to look at PayPal. I think we skipped Adobe there. We're going to go back to Adobe in a little bit. So PayPal for the past 5 days or since the start of the year has lost about 2 percentage points. Not that bad. And they clearly lost everything they've gained in 2021. They lost 21%. So Adobe, let's look at Adobe since they've been falling off the cliff since the start of the year. Adobe at $510 a share has lost 10% in the last 5 days or since the start of the year. And since 2021, they have just gained they have retained at least 8%. So clearly the top loser among these among these companies that we have discussed is PayPal, which lost how much? 20%. And if you're going to look at Shopify, not so much. Yeah, PayPal is the big loser in terms of market returns since 2021. All right. Now we're just going to go to our roll the clip segment. You ready, Wowie?
I'm ready.
So we have two takes, one negative, one positive about the stock market. So we're gonna go first with the bond king, Jeffery Gundlach. So honestly, this guy, as Wowie and I are already aware, this guy usually comes up whenever there's market turmoil or sell-off. So he inserts the negative, outlook. But it's always helpful to listen to him because he won't be in this spot. People or analysts or Wall Street won't be listening to him if most in fact in the time he's incorrect. So he always brings out valid points. So this is an interview that he gave to Yahoo Finance back in January 4th, garnered 7,000 views. Finance channels don't usually get a lot of views, but it's always good to highlight. And
they get one view from me.
One view, yes. And it's always good, for listeners who have stuck with us so far. We appreciate you guys. Thank you guys for giving us the opportunity, to share our thoughts. But regardless, we do this out of passion. Me and while we just, do this out of hobby. If we're gonna be doing this for income, I don't think we'll be here lasting this long at this time at episode 29. So we're just doing this, out of hobby. So we're gonna play this finally. It's entitled Bond Expert Jeffery Gundlach says a recession may be coming soon. Let's roll the clip.
Let's bring in Yahoo Finance's Brian Sazi with his exclusive conversation with Jefferey Gundlach, live from LA for us this morning. Brian.
Hey, thanks so much, Akiko. Yeah, on the 18th floor here at Double Line, watching a big, beautiful sunrise here in LA. But I caught up with Jefferey Gundlach, the founder of Double Line, yesterday at his California estate ahead of their Roundtable Prime, where they share a lot of their investment outlooks and ideas for the year ahead. He suggested investors really pay careful attention to the bond market because it might be saying a recession could be in the cards.
I think the bond market is already showing enough of a recession indicator that by 2023, it seems pretty likely. And like I said earlier, I don't think a lot of the Fed officials and economists, investors appreciate the fact the economy keeps buckling at lower and lower interest rates. So I think the Fed only has to raise rates 4 times, and you're going to start seeing really a plethora of recessionary signals. I think it's certainly a non-zero probability that you get a recession in the later part of 2022. That's going to be dependent again on how aggressive the Fed is and the like. So one thing that we did notice in 2018 is the Fed they stopped QE, they started quantitative tightening, letting the bonds roll off, and then they started raising interest rates, and we got an instantaneous bear market.
And Akiko and Zach, let's keep in mind when that call by Gundlach is coming. Well, we just had Apple hit a $3 trillion market cap. Equities are trading at some of the highest valuations in years, and it is overlooking in many respects these moves in the bond market. We saw the bond market, the 10-year yield had its really the strongest first day of trading gain since 2009 yesterday. So at some point, somebody will be right. The market looks to be right now in terms of equities, but I think what Gundlach said is very, very telling and very important for longer term investors.
And Brian, I know he also weighed in on what's playing out over in China. There's been a lot of questions about whether, in fact, the opportunity within China, particularly the growth opportunities there, still outweigh the risk factors that are there on the ground. What did he say about that?
Yeah, I have a full story hitting shortly soon, Akiko, on this on the Yahoo Finance homepage. But in short, Gundlach telling Yahoo Finance that he views China as uninvestable, really going at length and talking about how the Chinese government has cracked down on Chinese internet companies. Of course, it's a story you've been following very closely, the issue with Didi, but also too, warning about the relationship between America and China, how it is still fray. But again, Jefferey Gundlach telling Yahoo Finance exclusively, they just views the country as uninvestable here at this point.
All right, so Wowie, China is uninvestable and recession in 2023. Oh, Wowie, you're on mute, I think. Ask to unmute. There we go.
I wish he had expounded more on what he meant by, uninvestable.
Because of the government thing, I don't know. But yeah, full disclosure, I have sold my losing picks, Alibaba and Tencent. I lost more than maybe 48, almost a little more than half of my investment in Alibaba, and Tencent about 30 to 40%.
That's not unusual.
Mm-hmm.
Have you been holding on to your Alibaba shares?
No, I sold it a couple of days, I think, before the end of the year, just to get the tax harvesting thing. But I'll plan on, buying back those shares after 30 days after that kind of like rule, right? You have to not buy them right away because that defeats the purpose. So you have to wait for 30 days and, give or take, I'll be losing a little bit of returns because Alibaba has been, going back up. So we'll see how it goes, if we're going to go in or not, but I'll just update you guys. So a recession in 2023, according to the Bond King, and China being uninvestable. So there'll still be opportunities in China. I'm quite sure about that for sure. So this one, obviously, our next clip is the ever bullish guy, Tom Lee, Fundstrat.
Okay, interesting. Let's see what he has to say now.
Yes, he has garnered 230,000 views. Well, give or take, this interview happened even before Christmas. So,
with the recent downturn, let's see if he says something different.
Yes, let's roll the clip.
Stocks catch a break. Fundstrat is out with its 2022 market outlook. The forecast calls for new highs, but it may not be smooth sailing, and they may not come right away. Let's bring in Fast Money friend Tom Lee. Tom's a managing partner of Fundstrat and a CNBC contributor. Tom, always good to see you. Ultimately, you're calling for a pretty good year next year, 11% or so, but all the gains are going to be in the back half. What happens in the first half?
I think the market's going to struggle with a lot of things you guys just talked about in the first half. You know, it's the supply chain glitches and the way it affects both GDP growth and perceptions of inflation. And we've got the midterm elections that really won't have any visibility until the second half. We've got the Fed tightening, and that liftoff might occur at the end of the first half. But in front of that, markets are going to be nervous. And we, of course, have COVID and the various variants and mutations kind of rolling through both the US and the rest of the world. So I think in the first half, it would make sense for markets to be flat or down. But the second half, I think we end up having pretty much a traditional bull market rally.
Thomas, Tim, how about the stocks? And we've talked about this on the show where we made mention of below the surface. There's a lot of stocks that have been in heavy bear markets, so beyond correction. Are these stocks that can recover faster in that choppy first half you're talking about? So some of the high multiple tech names, but not necessarily even that, even some of the industrial names, again, parts of the market that are down 20, 30, 45% off of 52-week highs.
Yeah, Tim, I think there's going to be some relief in January because, Omicron came in and, in just a matter of 2 weeks went from essentially 0% of cases to 73%. And as you know, in South Africa, it burned out after 25 days. So I think we're going to be sort of relieved when that happens. And it should help a lot of stocks that got annihilated over the past couple of weeks on the heels of that. But will those names bounce and hold their gains through the end of 2022? I don't know. My guess would be first half of 2022 will be very defensive, large cap and defensive.
Hey, Thomas, Jeff Mills. I had a quick question. I think your view is that inflation trends a little bit lower next year. I was just wondering what you thought about the impact on commodity prices and then ultimately what that means for the energy sector. I know that you're pretty positive on energy going into next year.
Yeah, energy is one of our top three groups. That's because there's a structural shortage of oil production versus demand. But I think a lot of the inflation we're seeing in 2021 is goods related. Five of the six categories contributing to inflation growth are things like used cars, autos, apparel, home furnishing. Just those five are 2 percentage points of inflation this year. So I think that's what sort of weakens. It's not necessarily commodity prices because commodities end up being inputs onto that. But, I think oil prices actually are going to distinguish themselves and probably rise, actually.
Tom, amazing work as always. So a couple of these resource names are getting off the mat at a very interesting time in terms of everything we've just talked about. What does that tell you? I'm not looking to play stock market here, but the resource trades to me significant, talk about this global growth dynamic. Does that make sense? Are these stocks telling us something?
Basic material stocks only can rise when they sort of sniff better growth. I do think it's encouraging. I would say one of the surprises in the last couple of days has been the rally and things that are heavily impacted by both economic sensitivity and by COVID. And maybe the market is already starting to bottom and discounting the fact that Omicron's going to peak soon. But if it is, there'll be a lot of relief because, if you don't have a big rise in mortality, COVID is becoming less dangerous. And I think that could be one of the positives that emerge from this.
We know you like energy, as you mentioned, for next year, Tom. You also you liked it last year, and that was an epic call. Energy, the top performing sector year to date. And so you're saying in this new note that healthcare is positioned the same way energy is, which would imply a huge rally in next year. What sets up for that?
We were looking at relative performance, and energy's relative performance argument last year was that the 10-year stretch into 2021 was one of the worst ever. You know, in fact, we kind of joke that you have to go back to like the whale oil days to find a worse time to own energy stocks. And so energy equities became orphans, but the fundamentals were better. And we saw that in 2021. Healthcare has a similar setup, you know, that these groups had a huge derating of their PE, but earnings growth has actually been, you know, pretty impressive, and they are somewhat inflation resistant. So I think that there's a potential for their earnings to recover and PE to expand, and that would look a lot like energy in 2021. And you know, possibly, I mean, I think FANG has the same setup. So I think, you know, FANG and healthcare could have one of those 20, 30% kind of years.
Wow. Tom, good to see you. Thanks so much.
So energy, he said energy and healthcare, Wowie.
Yeah, energy and healthcare, and we're already seeing that both sectors have been improving.
Right. Yeah. Like speaking of fund flows, we just talked about, you know, them receiving a lot of fund flows in the first week of this year.
Yes.
So his call of last year at energy, really, you know, epic call according to that lady. So hopefully his call this year of healthcare, which is going to be this year is going to be energy. Well, he said that it's going to be healthcare representing energy performance. So we'll see if healthcare goes okay. We have to take a closer look on the healthcare sector then.
Well, then the benchmark would be your United Healthcare.
United Healthcare, Humana, Cigna.
Yeah, any move in those big companies will tell you how things are going, in my opinion.
Aetna has been acquired by CVS, right?
Oh, I didn't know that.
Yeah, CVS bought Aetna. Acquire. Yeah, I know they for sure. Yeah, they acquired Aetna in 2017. Largest acquisition.
That's good.
69 billion merger. But yeah, so healthcare is something to keep an eye on. I for sure know that some of them have quite also dipped in recently. If we're going to look at United Healthcare and Humana, since the start of the year, boom, down 2%. United Health down 8% since the start of the year. United Health. You're gonna look Humana down 1%, down 21%. Humana since the start of the year. So these companies have not escaped the sell-off, but it's something to keep an eye on those companies. So
yeah, looking at up to if you're thinking about investing in them, you have to look at their balance sheet
and revenue. So I think they're of big qualities as well. I'm for sure, because everybody here in the USA for sure needs an insurance. If not, you know, it's always going to be insurance kind of like appears to be like tax collectors in some way, so right? Because even before you get your payment, your salary, it's already deducted with insurance on a bi-weekly basis. So they get paid first. Their pockets get lined up first before we get ours. So it's kind of like tax collectors as well. So it's like a tall road or tall keeper.
Well, healthcare is a big component of the United States GDP, and that's why.
And yeah, going back to our slides, we're almost done. For our listeners who are still with us and haven't hit subscribe, please hit that button. Well, if you don't mind, you know, hit the button, hit the like button as well. If you don't want, that's fine. So JP Morgan, this is
still click and subscribe.
So this is just a slide that I saw from Bloomberg. It's a JP Morgan outlook for this year. So it's an optimistic one. So we're just gonna read through it. JP Morgan, our view is that 2022 will be the year of a full global recovery, an end of the global pandemic, and a return to normal conditions we had prior to the COVID-19 outbreak. We believe this will produce a strong cyclical recovery, a return of global mobility, and strong growth in consumer and corporate spending within the backdrop of still easy monetary policy. So they're looking at the year of the bull this year for sure.
Well, I have to agree with that analysis because we're in a better position to handle the virus, right? We have the vaccine. We have more than 60% of our population here in the United States vaccinated. Geopolitical tensions have lowered down, and we're just waiting. We're in a waiting mode.
Right.
So waiting for normalcy.
Yes. Hopefully the Fed doesn't, raise the rates too high and suffocate all the money on the risk investments, aka the stocks. So sentiments, we weekly discuss these parts of the stock market. So what does the American Association of Individual Investors think? So the direction of the stock market will be in the next 6 months. For bullish people, they have dampened down from last year. So from 37.7% bullish outlook, it's down by almost 5% to 32.8. So people or investors are a little less bullish at this point in time. And they've gotten more bearish from 30.5 to 33.3%. So for the volatility, since the start of the year, it's not a surprise that volatility has increased because of the sell-off, primarily in the Nasdaq or tech sector. For the past 6 months, it's been trading within the range, up and down, up and down. Fear and greed index, we're currently at neutral compared to last week's greed. So because of the sell-off, we're now at neutral, still not bearish. Fear and greed chart, so we're still a little bit, in the greedy side of things. For the past week or since the start of the year, only 2 sectors have turned out positive. These are energy and financial. Believe it or not, healthcare is down 5%. It's the second worst performing, second only to technology at 5.7%. So energy and financial are garnering rewards again. Because if you're going to look at for the past year, energy and financial sectors are the best performing sectors in addition to real estate. So if Tom Lee's call turns out right, he's going to be doing it again. Oh, just keep in mind, for the first 6 months, he said it's going to be a little bit rocky. Or not that word, but it's going to be a little bit, up and down. People don't know what to do about their money. Or investors, the market will be a little bit shocked for the adjustments. But for the second half of this year, we're going to be getting more new all-time highs and return to the bull market. So fear and greed index on the Bitcoin or cryptocurrency world. Cryptocurrency, in contrast to the stock market, is more bearish. Currently, the cryptocurrency world is in extreme fear compared to last week's fear. I think the sell-off has been quite dramatic on that end. The put-call ratio, going back to the stock market, put-call options, it's not that gloomy as well. So put isn't that high. It's about trading within the range, not that scary at this point in time. Not people buying a lot of put options to cover their calls or stock investments. So not that troublesome. We're just about in a neutral in that aspect. So the financial conditions index, which we usually take a look at. So for December, the financial condition has eased a little bit, which is a good sign. So we're still in a negative overall, but like we have pointed out on our previous episodes, it has been climbing up since June of last year. So it kind of dampened down in December, which is interesting. Extra tight. So we're probably going to be adding this as well moving forward. This is the bond yields. Just because we're inspired with Jeffery Gundlach's interview. So he's saying that next year we're going to definitely see a recession. So the bond king is very much, reflecting on these kind of data. So this is a Bloomberg chart. Junk bond spreads remain ultra narrow, suggesting investor confidence. So this is an article that was published last week. So it looks like, in comparison to where we were at during the lockdown days of March 2020, which it had spiked from a relatively 4 percentage points, it spiked to more than 10%. We're still at 3 percentage points as of January 3rd. So if this chart spikes, it means that there's some trouble brewing ahead of time. So this data, according to the Federal Reserve, it tracks performance of US below investment grade issued in the US stock market. So the higher the yield goes, the panic ensues, or give or take, both at the same time occurring at the same time. So COVID infection, as we haven't taken a look, back during the lockdown days, March 2, 2020, we started at 16,000 cases. I mean, 16 cases. Now we're at all-time high January of this year. So definitely from 200,000 at December of 2020, we're now at almost 1 million cases because of the new variant. Hospitalizations, as while we have discussed, COVID hospitalizations back during the peak, or not peak, but probably, high points of time back in January 11 of last year, hospitalized were at almost 128,000 people. In the ICU, we had 28,000, 28,470 divided by 127,997. So we had at least 22% of those who were hospitalized in ICU, 22%. At this point in time, we have a lot less hospitalizations, but it's definitely been increasing at 109,000, but ICU at 20,250. That's 18.5%. So if you're gonna look at it a percentage basis, it's not that bad. As of course, it's terrible for those who are in the ICU, but still, from 22 percentage points back in January of last year, we're at 18.5 points percentage. So a little less harmful, but still, gives people enough worry to be at least on their guard, get those boosters and wear those masks. Yes, Maui?
Yeah, I would like to add an insight there. Definitely what you just said, get your shots, your booster shots, and wear a mask.
Mm-hmm.
One of the most vulnerable segment, aside from the elderly, will be the younger population
Right.
that are not able to receive the vaccine yet. So children are likely vulnerable to the virus, especially if it mutates. You have to consider that they are not vaccinated. So it's
Right.
still, in my opinion, I think it's still prudent to get your vaccine and mask. It will help keep these young kids healthy, in my opinion,
Mm-hmm.
until they're eligible to get the vaccine.
Right. 100% I agree with that. What do you call it? Saying, Maui, protection? I know. Prevention is better than cure.
Yes.
So yeah, the Fed balance sheet. Interestingly, while we did right November when we had our episodes back then, Federal Reserve was actually looking to lessen their balance sheet. But this graph from their website
I wish that was the
updated.
S&P 500 right now.
Yeah, but looking at their website, I mean, it hasn't even dampened down. So we're at $8.76 trillion in federal balance sheet. So despite them trying to curtail their bond buying, I'm not sure if I'm right. We're looking at the right chart, but it's still ever increasing. So, and lastly, and part of our sentiments segment is the forward price to earnings ratio. So since the start of the year, we're trending around 21 times for the S&P 500 large cap. If
That's
you're gonna
good.
look at the mid cap and small cap, though, it's been a sell-off. Mid cap from almost 24 times, now they're at 16 times. Small caps, who's definitely suffered the most, from nearly 28 times, they're down to 15 times. So the sell-off is in the small parts of the small companies, small high-flying growth companies. And before we end this episode, I guess, just a couple of highlights for 2021, the best and worst performing S&P 500 stocks. This is a graph from Goldman Sachs. So best performing stocks in 2021 as of December 30th, 31st. Number one, energy. Devon Energy, up nearly 200%. Next, followed by energy again, Marathon Oil, up 150%. Third, followed by Moderna, Huawei's Moderna, 143%. And then some information tech, Fortinet, Signature Bank, Ford Motor, 137% for Ford. I'm surprised Tesla is not even on this list. Let's see. No, it's not here.
Probably
Bath,
way down the list.
yeah, Bath and Body, Nvidia, Diamondback Energy, which is also an oil company, Nucor Materials, Gartner. So you'll be able to pause this part of this video, if you want to dive in more, if you're on our YouTube channel. So for the bottom performing stocks in 2021, number one would be Penn National Gaming, down 40%. So I think this is one of that Twitter guy's company. Barstools, what's his name? I forgot his name, but yeah, he's
Yeah.
one of that guy. I forgot his name. who just started investing in the stock market in 2020. He was making waves for sure. Whatever he picks, people follow. Next one is Global Payments, nearly lost 40%. Las Vegas Sands. Interestingly, despite the reopening, people flocking to Vegas. I myself, you yourself, while we went to Vegas, I myself went there twice, but still, Las Vegas Sands, who owns the Venetian, which is a really nice hotel and a casino, like one of a kind, is down 37% in 2021. Activision Blizzard, which is communication services, as I would consider as also information tech, down 30%. Citrix, Wynn Resorts, down 25%. So if I had listened to my gut back then in 2021 and started buying some casino, I would have been losing money on these casinos despite the supposedly reopening place. Wow. Discovery Communication, Twitter, PayPal, no, I lost 20%. Walt Disney, 15%. These are reopening place. VFC, they have lots of brands too. I think VFC Products Company. I think they own Ralph Lauren. No, Ralph Lauren's is a different kind. VFC, 13 brands, outdoor, active, and work. Yeah, they have lots of brands. The North Face, they own North Face, Vans, Timberland, and a lot of other stuff, but still they underperform. Interesting. You would think people are buying clothes now. But
yeah, along with cruise lines, I think
cruise lines, yeah.
This would any trending rise in these companies would indicate a normalcy.
Campbell Soup as well. Well, they've skyrocketed during the lockdown because people were buying their stock or their canned goods during the lockdown days, but they're one of the worst performers. Right. Well, for now, Wawi, before we kind of like end our episode for today, do you have any quotes for the week?
Well, just Ken Honda, author of Happy Money, always keep an abundance mindset.
Mindset.
Yeah, and he says, say thank you every time you gain money, and say thank you every time you lose money or give away money.
It's like always, it's hard to say thank you if you lose money, but I think making a self-reference or reflecting on it still give you something to learn from if you lose your money, right?
Yes.
Yeah, well, that's a nice quote. They're very fitting because the start of the year hasn't been really smooth sailing for most of the investors. But yeah, well, Wawi, thank you so much for coming on today on our first episode of 2022. Happy New Year to you guys. And if you have any questions, send your questions to markuwawishow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. A bountiful new year ahead to us all. This is Mark Yu signing out.
And And Wawi Santos signing out.